Hi, my name's Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Now, in last week's blog, as you would be aware, I talked about the tax changes that have been approved, haven't got royal assent, at least not as I'm recording today's episode, but essentially they're entrenched in law now, certainly will be very soon. And so what I wanted to do today is visit the question, is it still worth investing in established residential property, given the magnitude of these changes? And I'm sure there's going to be a lot of commentary around this, probably from some groups that have vested interest. But I'd just like to remind people, in fact, I received a question from a journalist this week and they thought I was a buyer's agent, which is kind of a bit funny. So I think it's probably important just to ensure that there's no confusion. The business that, I founded and I run, Pro Solution Private Office, we are asset class agnostic. So we don't have a vested interest of whether our clients invest in property, shares, or really any asset class. We've got no vested interest. We don't care. We've got deep experience in both. So we also don't have a leaning in certain directions. We've got some clients that are heavily invested in property, some clients that have none, and we're completely fine with that if it's appropriate for clients. So I just want to put that out there in the open. Hopefully it's obvious to most listeners already, but I just want to make sure that's really clear. That's not to say that my analysis is the be all and end all. It's just really to declare I don't have a vested interest. I don't really care whether established property is still a good strategy or not. It's not going to change my life, and it's certainly not going to change my business either. Now, the reality is the quarantining of negative gearing, which really means that you carry forward losses and offset it against future income and or capital gains. The quarantining of negative gearing associated with investing in established property materially reduces its attractiveness as an asset class, as an investment option, investment tactic. And anyone that tries to say the otherwise probably has a vested interest or doesn't really understand basic mathematics like internal rates of return, but it absolutely does significantly move the dial. Now, hopefully I can explain in very simple terms why that's the case and then back it up with some maths, because hopefully this claim isn't that controversial, but essentially the ability to claim negative gearing reduces an investor's annual holding costs. But if the benefit is quarantine, so negative gearing is quarantine, an investor's going to get the benefit of negative gearing eventually, but I worked out it could take more than 30 or 40 years to actually eventually eat up all those carried forward losses. And we know the time value of money is important, so a deduction today is worth a lot more than, say, a tax deduction in 30 years' time. But if my holding costs are higher, materially higher, that's okay, but I don't earn any more return as a result of my holding costs being higher. So it doesn't change the capital growth profile of the property just because negative gearing is quarantined now. So my holding costs are higher. I've got to put in more capital because obviously most property investors borrow the full cost of the initial property purchase. So we don't have to put in any of our own cash. Our own cash contribution comes in the form of meeting the holding costs. So if my holding costs are much higher, putting more cash into the investment, but I'm not getting any more return as a consequence of that. And of course, therefore, it affects the effectiveness of that sort of strategy. So let's put some really simple numbers around it. Let's say I've got an investment property and the net rental income, so the rental income after any direct expenses, property management, council rates, insurance, maintenance, these sorts of things, is let's say it's $20,000. And let's say the interest cost related to the loan that I used to purchase that property was, say, $60,000. So $20,000 income less $60,000 of expenses mean I'm losing $40,000 a year. So before the budget, I was able to offset that $40,000 loss against other income. And if I'm on the highest marginal tax rate, being 47%, that essentially reduces my after-tax cost to about $21,000. So I go and buy the investment property. Each year I'm putting in $21,000, and I hope if I hold that property for many decades, one day I'm going to sell it. I'm going to generate a huge capital gain. I'm going to pay some capital gains tax, but I'm going to keep most of the net gain. And that's how property investing works. However, if the loss can't be offset against other income, it's got to be quarantined and carried forward, then what it costs me to hold that property is $40,000 a year, not $21,000 a year. So almost twice as much. But I don't get any more return. As I said, I don't get any more capital growth just because someone's decided to change the negative gearing taxation rules. And as I said, I can carry forward that negative gearing capital loss. I work out that maybe it takes around 15 years for a property to start producing a taxable profit. So in 15 years' time, it won't be that material, but I'll start to eat away at these 15 years worth of carried forward losses. And I worked out it's going to take me 40 years to eat up all those losses. And or maybe one day I sell the property and I make a capital gain, I can offset the negative gearing against that. But all that is completely inferior situation as opposed to receiving a tax deduction today, like I would pre-budget. And that maths is reflected in the internal rate of return. So an internal rate of return tells me what return have I earned based on an average percentage basis from making those contributions. So before the budget, the $21,000 a year that I contributed on an after-tax basis, or post-budget is now $40,000. So what's the internal rate of return on both those scenarios? And so I worked out pre-budget with negative gearing with the old capital gains tax rate that a typical investor in an investment grade asset would earn an after-tax internal rate of return of 11%. So I'm putting in $21,000, I'll earn after all taxes 11% return. That's a really attractive return. That's always worth doing. And it's really thanks to the negative gearing and the actual gearing within the strategy that magnifies returns. However, once you account for the quarantined negative gearing losses, the internal rate of return drops to 8.4%. That's substantially lower than the pre-budget 11%, of course. And I reckon you could probably earn 8.4% inside superannuation, remembering that superannuation is concessionally taxed during accumulation phase and achieves a zero tax rate in pension phase. And so I think you can get similar to 8.4% investing in super, and you don't need to borrow, so you don't have the risk associated with that. You don't have the concentration risk, don't have the liquidity constraints, the transaction costs, the legislative risk, the tenant issues, and the general hassle with managing a property ongoing. So for this reason, I think the CGT and the negative gearing changes really makes borrowing to invest in residential property substantially less attractive, and I think less attractive to other options that are available to all investors. Okay, so let's talk about some alternatives, because in 2024, I produced an episode that I called livevesting, which is kind of a play on the term rent vesting, but sort of moved in the opposite direction. So rent vesting typically involves, renting where you want to live, then investing elsewhere, where live vesting kind of means the opposite. It involves directing as much of your financial capacity as possible into one asset, being your family home. And if I'm frank, it really means putting all your eggs in one basket, but putting it in a great basket. So instead of owning, say, a home and investment property and spreading your financial capacity across two assets and maybe ending up with two average quality assets, the strategy is to put it all together and buy one fantastic quality asset, albeit initially used as your family home. And if I hold that property for several decades, I'm likely to generate some substantial capital growth, of which is tax-free, notwithstanding the ability to live in an attractive location has a lot of lifestyle benefits as well. And look, prior to budget night, one of the benefits of borrowing to invest in residential property were the tax benefits that went along with it, the negative gearing benefits and so forth. But if they're removed, all of a sudden the family home starts to look really attractive, because it too, you don't benefit from negative gearing, but also you don't have to pay any capital gains tax either. So from an after-tax holding cost basis, the cost to hold an investment property versus a home is broadly similar. And arguably, given today in terms of relative value, in some locations, investing in a family home starts to become even more attractive. So again, if you think about Melbourne and relative value compared to, say, Adelaide, Brisbane and Perth, you would say that a family home is quite attractive relative to, history or decades of history, and to an extent Sydney as well, but obviously to a lesser extent. So that strategy looks attractive, particularly for someone that's prepared to hold that asset for, many decades. Of course, there's one big caveat. If you're going to live vest, you've got to make friends with downsizing in the future. I mean, the strategy only works if one day you financially crystallize that equity on an after-tax basis, and then you can use that equity to supplement, your retirement income and your retirement savings. So that's not going to suit everyone, and it's not everyone's going to want to downsize. You might become emotionally attached to the family home. You want to stay in the location. You might want to downsize in terms of accommodation size, but not compromise on location. And as a result, you might need to spend kind of a similar amount. So you certainly need to get your head around it. But I think given the changes in negative gearing, the gap between the financial benefits between, investing in your family home, albeit a downsizer strategy, and borrowing to invest in established property, that gap is certainly closed. And I would say that live vesting starts to become an even more attractive scenario, particularly if you're in Melbourne, for instance, and to a lesser extent, maybe in other states in terms of relative value. And notwithstanding that, there are some pretty significant added lifestyle benefits as well, in terms of potentially being in an attractive school zone, being closer to work, closer to better amenity and lifestyle options. Now, apart from investing in your family home, I'm sure there's going to be an absolute groundswell of buyer's agent espousing the benefits to investing in commercial property or even new build property, whether that's a house and land package or, off the plan apartments and so forth. But I'd be very cautious with these potential alternatives. I recently wrote a blog, recorded an episode 412 about commercial property, and just saying that looking at historic metrics, they look very stretched. So they're selling at very low cap rates, very low yields. And if there's some eventual mean reversion, I think there always is, that there could be, quite a bit of headwinds for commercial property investors in terms of a reduction in value of those assets that could more than offset maybe the higher income that have first attracted them to that property at the outset. And there's some good reasons to understand why that market's been pretty hot and why there's more investors looking for commercial property assets now than what there were, say, 5 years ago. But I just don't think it's the right time. That's a generalized comment, of course. I'm not saying every single commercial property in Australia is not worth buying, but I think you've got to take a very, very cautious approach and be very careful who you trust and what advice you listen to. Similarly, also investing in newly constructed property, again, whether that's a house and land package or, an off the plan apartment. I haven't written about that for probably almost nearly 10 years, so maybe I should do that again. But typically the attributes just don't justify or have the fundamentals to drive returns. So firstly, new build property tends to be in non-investment grade locations. So you think house and land packages tend to be on the outskirts of capital city where land supply is abundant. If we think about off the plan apartments, they're typically in high density developments. Often, if there are in the suburbs, they tend to be on main roads, busy main roads, because that land is a little bit cheaper, or, in areas where they're competing with really a lot of supply. The second element is most of the purchase price is spent on the improvements, not the underlying land value. Now, of course, that matters because land tends to appreciate, whereas buildings tend to depreciate. So if you're spending more money on the improvements on a depreciating asset, that's going to have a structural headwind in terms of generating long-term capital growth. And then third and finally is the price paid isn't really always an open and transparent market. So the price you pay is often set by the developer, and they need to bake in their marketing costs, commissions, incentives that they might need to pay. And it's really difficult to know what the property is truly worth because it's never been bought and sold on the secondary market in an open and transparent way, much like established property is being bought and sold in. So in short, I think the alternatives of, say, buying new build property that does have negative gearing attached, and also, or potentially alternatively, commercial property, neither of those investment opportunities look particularly attractive to me now. So really, investing in established property has certainly moved the dial. I think there's better things you could do with your money. Investing in the family home still, I think, has a lot of merit and is very attractive. Investing in new build property or commercial property is a no-go. But I think we can look to history here to give us a little bit of guidance of what the future might hold. Because the Hawke-Keating government quarantined negative gearing from July 85, but later bowed to political pressure and reinstated it in September 87 after the July 87 federal election. And at the time, rents in Sydney were certainly under pressure and vacancy rates were really low, but property prices and rents were relatively stable for that sort of 2-year period between 85 and 87 in most parts of Australia. Ultimately, it wasn't a dramatic collapse in, say, housing prices or an explosion of rents that forced the policy reversal. It was really sustained political pressure from housing construction landlord groups that really increasingly made the policy politically unattractive. A similar pattern emerged in New Zealand. They quarantined or denied interest deductibility for property investors from around October 21, and that was reinstated between April 24 and April 25 after an election in October 23. Again, it wasn't easy to pin, say, rental increases or changes in property prices over this time. A lot of things were happening. Interest rates were changing a lot. It was during that COVID period. So it wasn't clear that the policy created any negative economic impacts like higher rents or lower prices. It was really just a growing groundswell of the policy just being unattractive. And in fact, the policy was unattractive to both sides of government by the time they got to the October 23 election. So really, when you look at those two examples, we can't really point to, oh, this is going to lead to higher rents or the property market's going to collapse and that's why the policy will change. It's really just the policies became unpopular and they were changed both as a result of a general election. And of course, we're going to have a general election in mid-28. So kind of history could end up repeating itself. And really, at the moment, it's popular to say that we embrace property price decline. Certainly the Greens have said that. Labor said we're okay with it. There's lots of, parts of commentators in the market that are saying we're quite happy for property prices to decline. And conversely, it's kind of seen as a little bit greedy or too capitalist to say the opposite, that, people hope that property prices rise. But the reality is a little bit more complicated than that. The reality is most homeowners, including first home buyers, probably want property prices to rise. I mean, if you think about it, no property buyer wants their property to fall in value, and particularly first home buyers because they tend to be more highly leveraged. So people want property prices to fall before they buy, but they want them to rise typically after they buy. And remember, approximately 2/3 of Australians are homeowners, and you've got to back the horse of self-interest. Now, put the voters aside for a second. The government itself has a strong incentive for rising property prices. There's a large amount of government revenue linked either directly or indirectly to rising property values, including things like stamp duty, land tax, council rates, fees, capital gains tax revenue, and lots of different property-related taxes or charges or levies. Falling or stagnant property prices are very bad news for governments and particularly for state governments. It's easy to sit in front of the camera and say, no, we support lower property prices. I think in the long run, the general sentiment around that fact will change. Another important point is to acknowledge that Australian voters have already voted on these or similar tax settings. So Bill Shorten took similar changes to negative gearing and capital gains tax to the 2016 federal election, and Labor lost. The policy was also a major feature in the 2019 election, which also Labor lost. Remember, they were going to quarantine negative gearing only to new build properties again back in 19, and it was voted down. So I think it's difficult to argue that there's ever been a clear electoral mandate for these changes. And if they're unpopular today, I think they'll just get more and more unpopular as time goes on. Now, whether that means we need a change of government for these rules to be wound back in 2028 or not, I don't know if that's really that important. I think if history is any guide, I think these tax settings will become more and more unpopular the longer they're in place and the more you'll have, self-interest groups sort of, I think, build a campaign against them. And it might get to a stage that even the Labor Party changes their mind leading into the 28 election, potentially with the policy to unwind them. So I think this is an interesting observation to keep in the back of our mind, because what we don't want to do is do a massive pivot in our investment strategy and then look back in mid-28 going, nope, we shouldn't have done that. We overreacted or reacted too quickly to these changes. So before I talk about, okay, given that backdrop, what do we do next? Before I talk about that, let's talk about the market and, my expectations of what's going to happen to the property market, because I think we'll be in for a little bit of a stalemate. I don't think prices are going to change dramatically. So plus or minus 10%, that's a significant change, I guess, but not really relative to the share market. I mean, the share market can change a few percentage points in just one day. But I guess in 12 months' time, if you told me that property prices will be 10% lower, I'd go, yeah, that's not unexpected. But if you told me they would be flat, I also wouldn't be surprised. So I don't think there's going to be major changes there. I think there's going to be upward pressure on rents, but I don't expect rents to kind of spiral out of control. One of their arguments is, the government's arguments is that if a property investor sells to a owner-occupier, so an existing property investor sells to an owner-occupier, that essentially you've got one less investment property, but you've also got one less renter as well. And I guess that argument holds weight at a macro level, but not necessarily at individual geographical level, because you could have, more renters, fewer in property investors selling, those sorts of things. But the reality is that in times of uncertainty, most Australians just defer making a decision. So, where there's a lot of uncertainty, and that's true certainly for home buyers and sellers. So I think discretionary sellers, so people that, have been thinking about selling over the next couple of years, they'll probably just go, look, it's a really soft market. I'm not going to do it now. There's too much uncertainty, notwithstanding tax changes, but also potentially maybe geopolitical uncertainty, interest rates, these sorts of things. And similarly for home buyers, same sort of thing. It's a big commitment in times of a lot of uncertainty. Most people are going to delay that decision. And with investors, investors that already own established property before budget night, they've obviously got the negative gearing attached to those assets. They'll be loath to sell them because, they think, well, if I sell this asset, I can't necessarily get back into the market and achieve the same tax outcomes. And so in a way, they're going to be treated like kind of pre-85, pre-CGT assets. Anyone that's owned a pre-85 asset has almost always hung on to it just because of the zero capital gains tax associated with that particular asset. So I think, there'll be fewer buyers than sellers. I think there won't be that many investors in the market, either as sellers or buyers. So that kind of takes 30 or 40% of the market out there already. And then I think there'll be fewer home buyers and sellers in the market just because of the level of uncertainty. And so I think that the market will just go at a stalemate. I think volumes will really reduce, and that probably should mean that prices won't change that much, because you really need an imbalance between buyers and sellers to really change prices. But if there's far less buyers and far less sellers, then, that's where the market tends to stay at equilibrium and prices don't change that much. Okay, so having said all that, what would I do if I was in your shoes as an investor myself, of course? Well, I think we're going to preserve optionality in case, the taxations do change, and avoid any kind of knee-jerk reactions, really big changes to strategy just off the back of these taxation changes. I guess the first thing is, investing on going and borrowing to buy investment grade residential established property today. I think I've made the case at the beginning of today's episode that there's probably better opportunities. Certainly as an alternative commercial property or new build property, I think we can take that off the table as well. I think there's better alternatives. I think in a situation where negative gearing is quarantined for the next couple of years, and let's say that we predict that in 28 it'll be reinstated, I think what we can probably expect is that property prices won't do much for the next couple of years, and then they'll really kick off after negative gearing is reinstated. Certainly happened back in 87 in Australia, although that's such a long time ago now that you can't really, it's kind of useful and it's also kind of not useful because it's so long ago. So I guess one strategy could be that, if throughout 2027 and even 2028, you formed the very strong view that the tax benefits were going to be reinstated, that maybe you could, consider buying an investment grade property in those period of time, in those years before it is reinstated, if you expect those prices to sort of kick off. But of course, that comes with a reasonable amount of legislative risk, and you've got to be comfortable with the underlying asset in of itself. But there could be some good buying opportunities. I'm not advocating it, at least not yet, but it's certainly something that you can keep at the back of your mind. In the meantime, I would consider alternative strategies, but still preserve your flexibility. So alternative strategies like maybe borrowing to invest in the share market, accelerating repayment of non-tax deductible debt, so your home loan, making additional super contributions, whether that's concessional or non-concessional or both. And look, the right mix of these strategies, or which ones you choose, is going to depend obviously on your personal circumstances and goals and these sorts of things. However, I would be careful about pivoting and adopting a strategy that materially reduces your ability to invest in property in the next few years' time, assuming it was your intention to do so before the 2026 federal budget. So if you never had any intention of buying more property, no worries, on you go, you keep going with your strategy. But if you were intent on buying investment property before budget night, you might put that plan on ice. You might pursue alternative strategies like borrowing to invest in the share market, but still preserve enough flexibility to be able to pivot if it does change in a couple of years' time. Because what you don't want to do is have a major change in strategy and then in 18 months, 2 years' time, look back and go, well, I overreacted. It's not really a good time. It's never a good time for a knee-jerk reaction like that. And I think if history tells us anything, I'm not saying you wait forever, but I would say that there's, I think, a reasonable probability of these tax changes being unwound over the next couple of years, but we'll find out in the next couple of years. Now, if we're in 2028 and there is no prospect whatsoever, or it doesn't seem like there's any prospect whatsoever of these being overturned, well, then that's when I'd probably make a permanent change to my strategy. But for the time being, it's probably better to preserve that optionality to be able to go back into property in a couple of years' time. Certainly in the meantime, avoid any really low quality or high risk substitute investment options like commercial property or new build, and really always consider the rules-based, evidence-based approach that I keep advocating and talking about, of course, in my new book. I've got to put a plug in there for Wealth by Design. But really, you ultimately, if you're going to embark on any investment tactic over the next couple of years, you really want to make sure that there's enough potential for return relative to the risk that you're taking. And remember, taxation settings matter. Tax is a major consideration, but only one of many considerations. So we can't become too tax focused. We can't build our investment strategy just around the tax settings of the day, but we need to be conscious of them, but not be controlled by them. Okay, tomorrow is the third installment of my 8-part series talking about how Wealth by Design has improved from 8 years ago when I wrote Investopoly. And I'm talking about building a savings engine running on autopilot. And to back that up, next week's Wednesday episode, I will do a deeper dive on that. So talk about the automation process, but also talk about using AI, particularly Claude, as use an app to help you get a better understanding of your income and expenses. And I've actually formulated a prompt that I'll share in that podcast, that episode, that you can use to go through the process that certainly I use personally and we recommend to all our clients, that will iterate and learn, what your spending looks like and how to allocate it. So I think a very valuable episode with some practical tools to implement it. Okay, until then, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.